Customers Matter is a podcast about customer-centred, omni-channel marketing in an age of digital disruption, mobility, and the Internet of Things. It's hosted by John O'Neill, a management consultant and founding owner of Commotion, an agency specialising in customer experience design and delivery.
I'm sitting here in downtown Sydney, Macquarie Street, with Jack Lowenstein. Jack's what's commonly known as a stock picker, a funds manager, but Jack's always been a little bit different. He's a disruptor and a pioneer in what's known as ethical investing. And we're going to talk to Jack today about his customer centricity and the way the investment markets have been run and evolved during his career. Jack, welcome to Customers Matter.
Thank you very much indeed.
Okay, so Jack, you and I first met, I dread saying this, but it was more than 20 years ago.
I think it's pushing close to 30 actually. It's pretty scary. We're so young still.
Well, exactly. And I'm sure it was at Bondi Beach. And I remember at the time, when I met you, you had a philosophy degree from Oxford, and you were working as a finance journalist on a pretty interesting finance publication. Have I got all that correct?
Yeah, absolutely. I was working for Euromoney Publications, which is it still is a large publication group specialising in what we call the old days they called it high finance. You know, how companies fund themselves and the banking industry in a big sense. And I worked there until the early 90s, when I had a brief career in stockbroking, and then a very good friend of mine at the time, a guy called Peter Hall, had a problem with a company who had an investment in called Cresta Blinds, and which we all know. Cresta was the pioneer of blinds, and the company had fallen on hard times. And he asked me to go into the company and stage a corporate coup, if you like, to get rid of the people who were running, because he thought they were doing a pretty bad job and not very honest. And we brought in a new team, and I stayed on the board, and we had a long turnaround strategy there. We managed to take the business from being on death's door, basically, to quite a successful business.
So it's kind of interesting that, and it's amazing what careers journalism sets people up for. But so you've made this transition from being a humble scribe into stockbroking first, and then into turnaround. So just tell me how you went from A to B to C there.
Well, look, I think like in life, I don't know about you, but I've always found that luck is very important. And what's even more important is when you sense a bit of luck, is to actually seize the opportunity with both hands. And sometimes it turns out to be not so lucky. That's the nature of the game. But in this case, I was very lucky. The opportunity in stockbroking, I was getting a bit bored with journalism. I was a bit tired of being an observer, not an actor, the whole time. And so I got the chance to go into small cap raising money for small companies. It's a very you meet some interesting characters there, some great entrepreneurs and some, frankly, spivs. But I'm very glad I had that experience, because it broadened up my contact base, if you like, from the very top end of the market, where I made many great friends, but was never going to be playing on equal terms with those guys, to the bottom end of the market, where I could probably enter and learn my trade more. And so that was the opportunity, and the Cresta thing was fantastic for me.
So how did that come about? You knew Peter, and Peter's a bit of a legend in the industry. And maybe for the people who are listening and watching this, you might just explain who Peter is and how you came to meet him, because I know a bit of the backstory, but I'd be fascinated to hear a bit more.
It's a wonderful story with a slightly sad ending. So Peter was a journalist himself. And then he went into stockbroking and funds management. He set up this business called Hunter Hall, and when I joined him in 1997, we had $13 million under management. It was just the two of us in a sweaty little office in Double Bay, and he had this very large exposure to one stock, which was Hunter Hall, which was Cresta, and it was vital to his business that we actually got a turnaround there. It really mattered to his business and the investors in the Hunter Hall Global Value Growth Trust. So I learned an awful lot from Peter, and Peter is still a brilliant guy, and one of his great strengths is the ability to see kind of like in a bifocal way the big picture and the fine detail almost in the same glance. It's an incredible skill to have, and I wish I had it.
So you, as I mentioned earlier, and it had struck me immediately, you'd been educated in philosophy. Peter, as we know, became famous for bringing, I guess, a new philosophy, and you must have been part of this to to funds management. Can you tell me, what did you guys bring to the table in common that disrupted the funds management market?
Look, I think at that time, deciding to be an ethical investor was regarded as being very brave. We did make that decision shortly after I joined the firm. We only had $13 million under management, and I think what the disruption it created was that for the first time, as we had very good investment numbers, people believed, that there was no impediment to good returns from having an ethical screen, as is not investing in certain designated sectors. And so I think that was a very important proof of concept for the industry in Australia. The other thing that I guess that was quite disruptive was the fact that we were very activist. We were investing quite a lot in smaller companies in Australia, and frequently we found we had problems in the companies we invested in. We made changes. In one particular case, we actually bought into a company which already had a problem, which we knew about, which was a company called Reinsurance Australia Corporation, which was reinsurers provide insurance to other insurance companies, and it got into trouble when it basically didn't have enough capital. We bought into that company with a view to try and turn it round, rescue the capital that was there, and then start a new insurance company, which we did. And it was a 10-year engagement for me. I went on the board of the company, brought another guy who was very expert, a guy called Richard Hill, to join me, and together with one other person who was already there, a fantastic guy called Ian Crowe, we managed to get, and a few other people joined us over time, we managed to get a fantastic turnaround there, and we started a new insurance company called Caledon, which got acquired by Steadfast and Munich Re about 2 years ago. So it was a 10-year cycle, and again, I've been very lucky to get these opportunities.
So that's what you call patient capital.
Well, it was we bought it in about 5 cents, and the eventual exit price was 45 cents. So it was a pretty good outcome, even though it took a long time.
And my business has been exploring. We're in the job of customer experience design and delivering against that. But increasingly, we're also interested in understanding how to help businesses surface a higher purpose. Purpose, not so much before profit, but purpose which enables profit, rather than anyone can buy what you do, but when people buy into why you do it, it's another level of engagement again. And I think I'm interested to understand whether that's something that you and Peter appreciated when you made this decision to only invest in ethically screened stocks. Did you say we've got a value here that exceeds the thing we're doing? It's more important than what we're doing. There was a higher purpose to it.
I think it's very interesting. We've just launching something called the Morphic Ethical Equities Fund, which is a listed investment company. So I'm really re-engaged with all these issues, and the world has moved on, and I hopefully matured a bit in the years gone by. But I think the first point to make is that when you're investing ethically, you've got to make sure you remember you're investing. You've got to get returns for people. You cannot compromise those returns. But the ethical bit is about making sure you make your investors money without making the world a poorer place. It's as simple as that, basically. The mechanics of how you get there are complex, but the aim is very clear. Now, I'm not only a philosopher by training, although I'm not a very good philosopher. I was lucky enough to go to Harvard Business School on a course called the Under-President Management course, and the head of our department, the head of the Department of Strategy, who was teaching us there, was also a philosopher by training. She's on the board of Gucci for a while. She's a very top level person, but she is a philosopher, and her approach to strategy is to say, think of the world without your enterprise, and then try and understand what space in terms of the value add you're creating, and that's your reason for existing. It's the world with you, and how it's different if it's a world without you. You've got to think about that, and if it's not big enough, you don't really have a value proposition. And in terms of customer focus, what are we adding to our customers? We're trying to add for our customers a good return for their retirement. We're trying to do it in a way that has very low volatility, so that the returns, they don't think they're very rich one day and very poor the next. And we're trying to do it in a way that means that they're not going to have over in the back of their minds the thought, oh, I made all that money, but I wasn't very happy about the way I made it. We're trying to give them the confidence that they're not making money from things that they're unhappy about in their broader life.
So the journey from Hunter Hall to Morphic and the ethical fund you've just established, what happened? How did you were in Double Bay? You and Peter had a shared vision. You started to do some turnarounds. You happened upon a higher purpose. What was the journey from there to here?
Look, the business was incredibly successful, and we started off as I say, at 13 million. We got to a peak of nearly 3 billion just for the GFC. And when I say we, and we were very lucky. We had a chap called David Buckland who joined us as the CEO, and that allowed Peter to do some of the more philanthropic things he wanted to do. The business was going pretty well. The GFC was a bit of a shock for everybody. We didn't have a particularly bad GFC. We didn't have a particularly good GFC, but I think it really was, I think, very exhausting for Peter. And I don't think he ever fully recovered from the shock of the GFC in the sense of just how much emotional drain it was. Because remember how it was. We were all managing other people's money, and it's not a game. These are real people's lives that are being affected, and we were at the intersection between the people, their assets, and our challenge responding to GFC. I think he just got a bit whacked out by that. I don't think he ever fully recovered, and certainly his attitude changed. And I grew increasingly uncomfortable with some things that were happening in the company. And in late 2011, I decided it was time to move on because I had a reasonably good reputation, and I was just worried that, for various things, I was just worried there were things going on that I wasn't comfortable with. So I moved on quietly. When I left, my partner in this business, Chad Slater, who was a brilliant young guy who I'd recruited somewhat against Peter's will, but he turned out very well at Hunter Hall. He said, well, if you're leaving, I'm leaving too. And I said, that's fantastic, because I was too young to retire and probably not rich enough either. So I said, that's great, come and join me, we'll start this business, which we've done. And we've built it out now to a 7-person investment team. And we've had it's been tougher, and I'm sure everybody ever does a startup knows what it's like. You always think you're discounting how hard it's going to be, and it turns out to be even harder. But it's all been worthwhile. It's been a tremendous learning exercise for me. I've been privileged to work with a fantastic team of people, and we have achieved the investment returns we wanted, which is to deliver roughly a 17% return to investors since we started, with very low volatility. And this is very important to me. People do worry about their money. And if they see the thing going up and down the whole time, they get very anxious.
So tell me, in terms of understanding your customers and in terms of the use of technology in funds management today compared with how it was when you first got involved, what's changed? Are customers more important than they used to be, and has technology disrupted in and of itself the way in which the industry works, or is it still business as usual?
So much change. I mean, I remember. I mean, one of the most important changes has been change to media. When I first started at Hunter Hall, and we had this big proxy battle to try and get control of Cresta, if you spoke to 7 or 8 newspapers and a couple of TV stations, maybe a bit of radio, you were done. Today, to get the same message across involves talking to 100 people, and that's because the whole media has become so much more. There's so much more specialization and dispersion in the media. That's one very important. So the channel to your customer has changed enormously. When we first started at Hunter Hall, almost every investor we had came direct to us. They may have been a financial planner who advised them, but they were our investor. We knew their name, their address, their phone number. Didn't even have an email in most cases at that time, and we could contact them. Now, most financial planners use wrap platforms that create that basically mean we've got a barrier between us and our end customer. Rating agencies, asset consultants, a whole swarm of people have come up to advise clients. And I think my view is that we're like everything goes in cycles. One thing, I'm still a philosopher. I do still believe everything goes in cycles. I think we've reached a point now where the cost to the end consumer of that enormous amount of interaction between you and your end customer have gotten so high, we're probably seeing a reversal of that. And one of the reasons why I'm so pleased from launching a listed investment company is it gives us a chance to go back to a much more direct one-to-one relationship with our clients. And that's very important because, especially in the ethical space, I expect to get tremendous value from our customers from hearing their feedback about the companies we're investing in and whether they're as ethical as I think they are.
So, in terms of the way the world's turned, in a way what you're saying is that perhaps unlike in other industries where the consumers have suddenly got more power, the consumers have become more distanced from the fund managers, the people who are managing their money, because of the the platforms that the financial planners are using and the way in which the money is actually placed? Are you saying there's all this disintermediation that's gone on between...
Or intermediation.
Or intermediation.
Yeah. It's been a very strange phenomenon. I think it's partly a response to the fact there probably were some cowboys out there, and there needed to be a bit of intermediation between the fund managers and some of the fund managers and their clients. They weren't necessarily selling the right products to the right people. But I think it has come at a cost, a financial cost, and it's also come at a cost to intimacy, because ultimately nobody's going to explain what I do better than I will. I may not explain that well, but I'll do my best. And I think that that you need that intimacy. And it's very interesting. In this same building where we operate, there's a chap called Jeff Wilson who runs Wilson Asset Management, who's got 45,000 shareholders in his stable of listed investment companies, and his relationship is all direct. In other words, stockbrokers do introduce people to his fund, but ultimately he has a direct personal relationship with them, and that's an incredible thing. And I've seen Jeff in action. He goes around the country every 6 months to meet investors in every capital city, and has a one-to-one relationship with everybody who wants to come along to those meetings. And believe me, hundreds of people come along, and I think this is a wonderful thing. And I think the opportunities to go as the cycle changes is to go back to that. It saves money for the investors, and it also means that you're going to get that more intimate relationship, which is how you improve your product and your performance.
So thinking about Morphic and going back to your Harvard strategy philosophers' view that you need to think about the space your business occupies and what the world would be like if it wasn't there, what does that mean for what you've thought about you want Morphic to be and to do? And what do you think it's doing that is unique and special and giving it its purpose?
Unique is always a dangerous word, but I think we have definitely carved a place for ourselves in terms of our focus on risk management, which is a hard concept to explain in practicalities. But what it means is making sure people don't spend time worrying about you having a terrible month one month and a great month the next. We've definitely carved a niche in that area in the way, and I think after 4.5 years, we're pretty confident that the method we've chosen to achieve that outcome does work. I think that's is genuinely a bit different from most of the other managers out there. We haven't really compromised our returns that much to do it. There is always a cost for insurance, but it hasn't been that great. So, and the other thing is the ethical screen. To us, the ethical screen elements that matter the most are things that are associated with global warming and climate change. It was Barack Obama who said that our generation is the first generation to experience the effects of climate change and the last one that will be able to do anything about it. Since we launched the new fund, the Morphic Ethical Equities Fund, my daughters, who are aged 19 and 16, have been incredibly engaged. You finally get to talk to your teenage daughters again. It's an incredible experience. And what's emerged to me is how much anxiety they have in a very deep underlying sense about the effects of climate change. I'm sure your son feels the same. And they know it's an issue, and they're really looking to us, our generation, to make sure we don't make things worse. And my little bit towards that is to have a very, very strict prohibition on our fund investing in fossil fuels. And we hope to make a statement from that. We also hope it's going to be good for investment returns, because we think ultimately that sector has to shrink. Otherwise, we're going to not be in a world we can live in.
So, in a very practical sense, the businesses that you won't invest in, anything with fossil fuel, is there anything else that you don't invest in?
Yes, we're not going to invest in alcohol, tobacco, factory farming, old growth forest logging. We're not going to invest in armaments. I think those are the main things we're not going to invest in. And we're also, because it's not all about negativity, we're also going to make sure at least 5% of the fund at all times is invested in things we think are going to make the world a better place. And that's principally things like new energy technologies. And we've got an example. We're investing in Alstom, who are the guys, for those of you in Sydney, they're the guys who are digging up George Street. Well, they're not actually digging it up themselves, but their tram's going to go in there, and they're a world leader in mass transport, ground mass transport. And we're investing in a company called Power Grid in India, which is developing what's called the Green Energy Corridor, which is a corridor. The emerging market countries like India and China have a great opportunity. They are the world's fastest growing carbon emitters, but they're also the ones who've got the most underlying growth in their power sector. So they're very focused on more and more of that growth coming from alternative energy, and they're having to build specialist grids to carry that energy. And Power Grid is an example of a company doing that.
So what's extremely interesting is that you've suddenly discovered, maybe rediscovered, an incredible passion. You connected with your daughters.
Yes, it's a good thing, isn't
it? You're proud to be not only screening companies out, but finding companies that are really innovating and adding value to the world. In a way, not only has it given your business purpose, it's allowed you to find other businesses that have got purpose and both celebrate, associate, and potentially grow with them.
That's absolutely right. I mean, but I do stress, that we've got to do our main objective is to help our clients have grow their savings and have good retirements. Our secondary objective, which we're not going to compromise either, but our secondary objective is to make sure that we do that without giving them the feeling that they're actually making the world itself a poorer place.
So, Morphic's been going 4.5 years, but your ethical fund is recently launched.
Yeah.
Was it a flashbulb moment? How did you come to go, right, the time is right? And was it something you'd been wanting to revisit, or where did it come from?
Well, look, like every startup, you're always conscious of the fact you've got lots of risks, and you don't want to limit your market unduly. So when we started up, we felt it was tough enough starting a new business with all these new intermediaries who are making it very hard to start a new business compared to when we started Hunter Hall. So we decided we couldn't afford to have an ethical screen. The reality is nothing in our current fund, the Morphic Global Opportunities Fund, would not pass the ethical screen we're going to currently apply. So it's more a question of applying the brand more formally to what we're doing rather than changing what we're doing. I'm not saying we've never had a stock that we couldn't have in here, but we've had very, very few.
But what was the catalyst moment to go, okay, I understand why you might have been anxious about that when you started out, but obviously something crystallised for you at a certain point in time, and you've said, well, we're going to make this statement, and it's a choice. And yes, you're focused on delivering returns and stable rates of return, but you're still making a choice, and it's an important choice, it seems to me. But what crystallised in your mind to say, yes, we're going to do this now?
Well, look, I was the proponent within Hunter Hall for the what's called the Hunter Hall Global Value Limited, which is their listed investment company, which was the first and still the only ethically screened listed investment company in Australia, or still the only one to win. Obviously, we're now in the marketplace, and I felt that that with the implosion of Hunter Hall, which happened over Christmas, there was a real need for an alternative to Hunter Hall, because Hunter Hall, as you may or may not know, has been effectively taken over by Soul Pattinson, which is a business which is whose largest, it's a conglomerate, but its largest single business is coal mining, and I felt that there was going to be a real issue there with the integrity of the brand, and I felt it was important that investors who want an ethically screened global equity exposure have a choice. So that's what really brought forward this opportunity for us. And we've been incredibly pleased. We got great broker support from the major brokers in this sector, including NAB Trade and Westpac Investing Online, Macquarie, Morgan Stockbroking, and Taylor Collison, who's our arranger. So we get tremendous support. We've had a very successful social media campaign. In a space of a week, we've had 5,000 website visits, unique visits, which is for us unprecedented. We've had 900 prospectus downloads, and I think that we really, like always, you seize the opportunity. And what we realised was a gap in the market. And put it in context, in America, 20% of all funds under management now have some kind of socially responsible screen, ethical screen overlaid on them. In Australia, it's probably less than 1%. We're way behind, and the reason has been lack of innovation by fund managers. It's not lack of demand.
So finally, thinking about your career and your values, your customer relationships, what are the key learnings that might be relevant for people, not just in your industry, but in other industries, as they grapple with the kind of issues of disruption and commodification that we've discussed, and I guess even as importantly, purpose?
Look, I think the most important thing I'm still learning all the time, is that ultimately what works in any financial service industry and many other industries is you've got to have a relationship of trust between your consumer and yourself. Now, the challenge with changing technology, particularly in media technology, is how you build that trust one to many, and how you maintain your sense of integrity and try and convey it to your consumers. To me, that's the biggest challenge in any business, but particularly where you've got people giving you their money, or not literally, in pound notes, but normally, especially when people giving you your money and expecting, to be cared for. They really want trust, and that's the challenge. And I think that what I'm learning during the campaign that we're having at the moment for the Ethical Equities Fund is you've actually got to you can't fake it. People got to feel it's real.
So there's something here about authenticity and value actually informing your brand and your behaviour. Would you agree with that?
Absolutely. You can't afford any dissonance, I think, in your messaging. If you do, you're lost. It's extraordinary how one blemish can mar an otherwise perfect picture. That's the challenge. And by the way, none of us are perfect, so they're going to find that blemish somewhere.
Jack, it's been great talking, and thanks for sharing at a time of such high demand.
Well,
a bit of your time with us.
It won't last. I should enjoy it while I can.
Thanks very much.
We hope you enjoyed this edition of Customers Matter. We encourage you to subscribe and, if you like it, rate and review it. Head over to Commotion.com/podcast. That's KOMOSION.com/podcast.